Hey, good afternoon, traders. This is Trader Tim coming to you from EminiMind, and I'm back from vacation doing another Monday market analysis video. It is August 15th, 2022. On vacation last week, so I didn't do any trading. I wanted to touch on, I was keeping my eye on potentially buying puts, but I'll tell you why I didn't end up buying puts. Some things that I saw just by, glancing at the markets occasionally. And then wanted to talk about a couple of trades from today. So let's just dive right in. On the ES daily chart here, you can see the full halfway back. We've broken the 61.8. That's pretty big because it's the full halfway back short. Now, it doesn't mean that we go from the 61.8 straight back up to all-time highs. It's likely there will be some kind of pullback, but that's definitely a huge run-up from where we've come. And in conjunction with the market going up, we also have the volatility, the VIX, going down like so, breaking below this triangle here and below the swing low and all the way back down to the low 20s. So sort of, we have a confirmation that as the market's been going up, volatility and fear has gone down. Now, if we go take a closer look at, the market coming up to the first touch of the 50% here, we kind of moved along the 50%, and that was right at the negative 61.8 as well. You can see this 50% retracement. We'd been talking about that a couple weeks back. And what was interesting is on this run up, you'll notice that there was a lot of overlap from the candles each day. Like we didn't just have a giant gap that was unfilled and then the market kept going. So like see down here, these are all of the gaps that have been unfilled, meaning we have not traded at the price 37.97.75 since closing on, in this case, the 14th. And then we have another unfilled gap up here, 37.50, yada, 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 all the way up. But look at this big chunk coming into the consolidation. Then we have the consolidation. We had the big gap up here on the 10th. And then the rest of the days have been pretty good overlap. We have one unfilled gap, 42.15 and a quarter, but the candle on the day still traded into the prior day's range. And when we get this kind of overlap, that's really healthy for the market. It means there's a lot of unresolved trades that are being, resolved, if you will, whether they're underwater, most of which are underwater, getting back to break even and whatnot. So with a run up like that, with the VIX coming down, and with basically any news that was hitting the market was being taken as good news, whether it was good or bad, whatever the numbers were, whatever the reports were, economic news-wise, the market was just taking it and going up. So when I see that kind of price action where, hey, a news report comes out, market goes up. It's good, market goes up. News report's bad, market goes up. You can see the same thing happen when news reports come out and the market goes down. Good, bad, market's going down. You don't want to be trying to buy the bottom and catching a falling knife in that scenario. And this was just kind of turned upside down where any news that came out, the market was going up. So don't want to be trying to short and stand in the way of a runaway train, if you will. You also have a lot of FOMO from all the folks who jumped into the markets, say end of last year, even anytime last year, and then when we sold off in June, they sold out, they closed their positions, got scared, jumped ship, and now they're basically they bought at highs and they sold at lows, and now they're missing out on the move, and so they're jumping back in. So you have a lot of that kind of FOMO that can help fuel some of these rallies that go so far beyond the negative 23 to negative 61.8, and it's like, man, it's just a straight line going to the moon. If you kind of connect some of these lows like this, I mean, it is just straight up. So with that being said, let's turn to, so that's a good reason why keeping a long-term position and then buying puts against it is a much better strategy. You're not buying puts every single week, maybe once a month, or when in certain cases when the market's in a strong downtrend, once a week. But by and large, I mean, the puts are there so that if the market does something like this, where it looks like the bottom's going to fall out, you don't have to sell out at the bottom and then get back in. You can just hang on to that position, collect your dividends through all this kind of move, and then all of a sudden the market's up, 3,700. Now we're all the way up at 4,300, and you're still in that position. And it's a lot less headache, and you do a lot better P&L wise by doing that. So let's turn to the intraday today. I wanted to talk about first the 15-minute breakout trade and then a short trade actually that traded maybe a half hour after the bell. So the 15-minute breakout trade has traded this morning, and let me get back to that. It traded about 20 minutes in. Well, actually, this one was right after the 15-minute mark. It triggered, if you will. It broke the 15-minute high, so that's here. And then about 20 minutes in, it finally started to get going. So the 15-minute mark, these can be a little bit tricky sometimes when the candle closes exactly on the 15-minute mark. Today we had the market pull back a little bit, and then it punched through about 30 seconds after the candle closed. So like the candle closed right about here, and then it punched through here. So today wasn't that tricky to get in. Sat there for about 5 minutes, not doing much. Came back, dipped in half a point or three ticks or so, a point, I guess, the exact number there, a point, and then took off running. And so one of the things with this trade is, you have to have the patience to just set it and forget it, bracketing that first 15-minute bar, and then letting it go to that 20-point target. Now in today's case, the trade went like, let me pull up my log here. The trade went about 12 points here, filled the gap, went a little bit higher than that, and then it retraced all the way back down, came back down to that 15-minute high, and then bounced. And so if you're going to take this trade, if you're going to take this trade, you need to take it every single day. And you need to be, consistent with it. There's just one trade a day, so you're taking it every single day, or you have to take it every single day. Otherwise, you don't have very many entries in your trade log, in your data set. And so one of the things that I adjusted to this year is using or I guess it was maybe partway through the year, towards, I guess, maybe February. Yeah, February is where I started to use a +4 as my moving my stop from -4 to +4 when price went 10 points in my favor to eliminate, taking a full stop out if I got some momentum. And earlier in the year when we had more volatility, that was great, and you'd still get, the market would go +10 and then boom, +20. Sometimes it'd be 15 minutes and you'd be out for 20 points. Well, now with volatility considerably lower, I'm finding that the market can still get these big pushes, but instead of a +30, we're getting like today where it's a +12, and then we pull back. And so I've had a number of trades over the last couple of weeks. Obviously, last week I wasn't trading, but going back the couple weeks before that, where I got taken out for 4 points, and then it came down, went a little bit below the break-even price. But the -4 would have still kept me in, and then it went up to +20. So I may end up scrapping the +4 and going back to the way I used to do it, which was setting a -4 as my stop, setting a +20 as the target, and then just basically walking away and let it hit either one of those. There's enough +20s where you take a -4, -4, -4, and so you're down 12, and then you take one +20, and you're net +8. So I'll just kind of keep my eye on that. We've talked about that in the live trading sessions on Tuesday, so just something to keep your eye on. That's why I bring it up. And then the last thing I wanted to highlight is the counter trend short from today, and that was at the top of kind of the top of the 30-minute range, right at this gap fill here. It was pretty much a textbook setup. High tick, we had the market sold off a little bit, but it didn't sell off all the way to the halfway back long, which was like so. So that was down here. This pullback came down, bounced, and this 78.50 is where the short entry was. And then from there, we came down, broke lows. Being that coming back from vacation, took this one a little bit, I guess, the stop more aggressive, if you will, and I started trailing each candle once we broke lows down here because we were coming into this halfway back long, and I figured, well, the market's been rallying pretty much every day, so the halfway back of the day is a good spot for it to bounce. So I don't want to just have my stop. If I drew the next 50% retracement, my stop above the 61.8 would be all the way up here at like a 42.76 and change. So I chose to be more aggressive, tighten my stop, and keep it down here. It was like a 73.25, I think, is where the exit point ended up being. So, it's always nice to kind of come back after a little hiatus and start off with even if it's just a small winner, just to kind of get the ball rolling again. So that's my decision making on why I trailed each candle here once we broke the swing low down here. So tomorrow morning we will be back doing another live trading session. Tuesday morning. You can check that out, eminimind.com/VIP. I hope everyone has a great week, and I will talk to you all soon.